Welcome to vTalkInsight, Market Drivers Daily for July 27th, 2026. After 2 weeks of energy shocks and rate jitters, crude is suddenly back below $90. AI capex headlines are running into the hundreds of billions, and the heaviest earnings week of the season is underway. Let's unpack how that combination is reshaping risk across oil, the dollar, and tech leadership. Energy and geopolitics have shifted from acute stress to uneasy relief, but the risk architecture underneath has not really changed. Brent has dropped more than $13 from last week's spike above 100, with several days of 5 to 7% declines as the United States paused strikes on Iran and both sides halted direct attacks around key routes. That escalation has taken crude back into the $80 range and pulled some of the geopolitical premium out of the curve, yet shipping through the Strait of Hormuz and the Red Sea remains disrupted, so the potential for another supply shock is still very much alive. Cross-asset price action underlines just how central energy remains to the macro story. Global equities and bonds are rallying alongside the oil slide, while European equities in particular are getting a lift from a 6 to 7% drop in Brent and falling regional gas benchmarks. At the same time, European energy stocks are down more than 10%. London-listed oil majors are under pressure, and diesel prices in the United States remain elevated, reminding markets that product tightness and refining margins can behave very differently from crude. Terms of trade are still a headwind for Europe because gas prices, although lower, remain high enough to weigh on the euro and on energy-intensive sectors such as German chemicals, where production has fallen close to 20%. Policy expectations are being pulled back and forth by this volatility in energy. On one hand, Brent dropping below $90 and recent disinflation data have eased market worries about an immediate oil shock, pushing global yields off their highs and supporting risk assets. On the other hand, central banks are wary that conflict-driven price swings could reignite second-round inflation effects, and the implied probability of another Federal Reserve hike has recently climbed toward the mid-30s as oil and geopolitical headlines turn more threatening. Foreign exchange moves in the G10 continue to track these energy swings. Currencies tied to energy imports, especially in Europe, strengthen when oil sells off, but remain structurally pressured by still elevated gas costs and fragile industrial competitiveness. Against this backdrop, the risk distribution for energy looks unusually wide. Portfolio managers still expect oil to trade in an $85 to $90 range, even if tensions keep easing, citing persistent risk premia around Hormuz and ongoing constraints in shipping and inventories. The counter-argument is that oversupply and softer Chinese demand, together with rerouting of Saudi flows via the Suez Canal, could keep a lid on prices and reinforce the current disinflationary impulse, especially if a temporary ceasefire holds. Key watch points now are any breakdown in talks around the mid-August ceasefire deadline, daily shipping metrics through Hormuz and the Red Sea, and how central banks frame energy in their upcoming meetings. Those signals will set the stage for how much room risk assets have, just as the AI and earnings stories take center stage. The AI theme remains the dominant structural story, but markets are increasingly focused on how the funding model evolves as the numbers get very large. Nvidia is reportedly backstopping financing for OpenAI data centers that could reach $250 billion, with total infrastructure deals alongside partners like SK Group and SoftBank potentially exceeding $750 billion. Executives now talk openly about the semiconductor industry needing to expand tenfold over the coming decade as AI agents and robots drive demand far beyond human usage, which, if realized, would reshape entire capital expenditure and supply chain cycles. The near-term reality is an enormous wave of AI-related capex, increasingly financed through debt and innovative structures. AI-linked corporate bond issuance is nearing $490 billion this year, heavily skewed to long maturities, while private markets have seen close to $200 billion of data center deals, supported by substantial dry powder. Some chipmakers are even providing credit wrappers or guarantees to help fund projects that will then buy their own hardware, raising concerns about circular financing and echoes of past over-investment cycles. Credit investors are watching whether these structures mask underlying risk, particularly as questions grow about negative free cash flow, high leverage, and the durability of assumed high 20s returns on invested capital. Equity markets still treat AI as the central leadership theme, but that leadership is becoming more concentrated and more fragile. Gains this year have been heavily driven by AI-related assets, and traditional 60-40 portfolios are looking less diversified because both the equity and bond legs increasingly lean on the same large tech issuers. There's a growing debate on whether the AI model landscape consolidates into a de facto oligopoly, anchored by names like OpenAI, Anthropic, and Google, or whether open-source ecosystems in China and elsewhere broaden participation and diffuse profits. At the same time, mega-cap tech stocks are no longer reliably rallying on strong earnings beats, as investors focus on capex intensity, thinner returns on capital, and uncertainty over how quickly AI demand translates into monetized cash flows. There are also strong countervailing supports that keep the AI trade intact for now. Cloud and data center businesses are posting revenue growth above 25% with expectations for even faster earnings growth. Yet valuations for some infrastructure and grid names remain undemanding versus the broader equity market. Microsoft is seeing accelerating adoption of its Copilot product, with active seats potentially surpassing 20 million, providing a tangible example of AI monetization at scale. Durable goods data show modest overall growth, but a sharp 3% gain in computers and electronics, underscoring AI hardware as a key macro growth engine. The key watch points over the coming days are earnings from hyperscalers and major chip makers, their updated capex and backlog guidance, and any hints of a pause in spending, which could quickly test both Nvidia's ecosystem and broader risk appetite. The third major pillar this week is earnings. And here the story is one of strong fundamentals colliding with stretched expectations. Equity gains in 2026 have largely been driven by earnings growth rather than multiple expansion, and profit resilience has surprised positively even against a backdrop of higher energy costs and rates. Yet a significant portion of the S&P 500 market cap, roughly a third, is reporting over the next few days, and recent price action shows that beats are delivering less upside while misses are punished more aggressively. Mega-cap tech names, including members of the so-called Magnificent Seven, have already seen cases where strong cloud or AI metrics coexist with negative share price reactions because capex and valuation concerns dominate the narrative. Recent single stock moves highlight how high the bar has become. Intel delivered strong earnings, but still saw its stock drop more than 7% as investors questioned the scale and timing of its capital spending. Elsewhere, Alphabet and Tesla have experienced negative reactions despite solid operational data, while some chipmakers are now underperforming as memory prices stabilize and decline, suggesting the end of a euphoric phase in parts of the semi-complex. At the same time, a rotation is underway into sectors with more modest valuations and perceived earnings resilience, with bank stocks logging multiple weeks of outperformance and insurers, industrials, and select cyclicals attracting interest. Outside big tech, earnings show both the reach and the limits of the current cycle. AstraZeneca continues to target $80 billion of revenue by 2030, supported by strong oncology performance. But management calls that goal a stretch, and consensus has already converged near that level, which caps the scope for positive revisions. In pharmaceuticals more broadly, excitement around AI for drug discovery has yet to translate into measurable productivity gains, so the benefit remains more narrative than numbers. Industrial and materials names, such as H.B. Fuller, demonstrate the importance of pricing power, successfully passing higher petrochemical costs from tariffs and supply disruptions through to customers, even as Middle East choke points complicate inputs. European insurers also face an additional layer of uncertainty from events like the large French wildfire, where the ultimate claims burden is still unclear ahead of their reporting season. The overarching issue is a growing disconnect between equity markets, which still appear to assume a relatively low cost of capital, and bond markets, which price in a higher for longer rate regime. Returns on invested capital at large tech firms are thinning just as capex and debt issuance accelerate, and equity allocations are already elevated, limiting incremental inflows into the parts of the market that have led so far. The counterview is that broad-based investment, including in AI and infrastructure, is underpinning a kind of manufacturing renaissance and helping keep GDP growth near 2%, which could support earnings even if multiples compress. For now, the focus is squarely on this week's results from Apple, Amazon, Microsoft, and Meta, along with key luxury and financial names. Their guidance on capex, margins, and demand will go a long way toward determining whether leadership broadens out or valuation fatigue forces a deeper reset. To pull this together, today's tape reflects three intertwined forces. Oil's sharp pullback is giving risk assets some breathing room, but unresolved choke points and fragile ceasefires keep the upside tail for crude and inflation very much alive. The AI build-out is powering exceptional growth in semis, cloud, and data centers. Yet the funding structures and concentration of risk are drawing more scrutiny just as mega-cap tech stops responding to good news. And a make-or-break earnings week is testing whether strong profits can still offset concerns about high valuations, thinner returns on capital, and already elevated equity allocations. Watching how these three threads interact across oil, rates, the dollar, and sector leadership will be critical over the next few sessions. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.